All right, so crazy week in the markets, mainly because on Friday it was a bloodbath out there. If you look at the heat map here, there's hardly any green. In fact, I don't know if I see any green here, to be honest. Let's just check out the heat map. Yeah, like literally everything was down on Friday, at least of the larger companies. The mid caps and the small caps actually outperformed, specifically the mid caps. But if Friday would have been a flat day, we actually would have been flat, or we actually would have been up slightly on the week. So that's kind of interesting. First things first here, if you get value out of the video, please like, subscribe, comment, check out those links below. Always appreciate the support. So like I mentioned here, it was the growth side of the market that led the market down. If you compare the Meg 7, the NASDAQ, the S&P, the equal weight S&P, mid caps and small caps, the worst performing of those was the Meg 7 followed by the NASDAQ. And if you look at the best performing ones, it was the mid caps followed by the equal weight S&P. So it was the growth side of the market that got killed. The value side of the market actually did not bad. And that's really going to be a sign of things to come. The real thing that I would keep an eye out for is that if on legs up, like when the market's up, especially when we see large, like weeks where the market's up 2, 3, 4%, if the mid caps, if the small caps, if the value side, like the equal weight S&P is outperforming the market cap weighted S&P, that's what I would keep an eye out for, because that basically means, hey, we're seeing the rotation. A lot of people are talking about this rotation that's going on. Yeah, it's going on to some degree, but is it going on to the extent that they think it is? I don't know. I think that we're still early in the process. The other main question here is why was the market down so much? Personally, I think it's an overreaction. I mean, there's basically two reasons. I mean, number one, it's recession, and number two, it's inflation, mainly due to tariffs. And if you look at the PCE index, that actually ticked up recently. Now, again, it was only 0.1 above expectations, but inflation clearly is stickier than normal, because, I mean, the Fed wants it to be at 2%. Why 2% is this magic number? That's another rabbit hole in and of itself, but we do know that they want it to be at 2%. And they expected it to be at 2.7. It came in at 2.8, I believe. So that's definitely concerning, but the economy is clearly weakening. And I mean, if you look at the survey where I forget what the exact terminology is, but basically the consumer confidence survey, I've heard it called, but I believe there's actually an official survey. And that's actually at the lowest level in, I think it's like 3 or 4 years. I think it's 3 or 4 years since it's been as low as it currently is. So that's pretty bad. I mean, whenever people's confidence goes down, I mean, they're going to spend less, which is going to bring down inflation. So personally, I'm not overly concerned with that. I think that the big concern would be, we get too much stimulus too soon, and that could stimulate another bout of inflation. But I mean, if you look at consumer confidence, if you look at a lot of things, like people's personal savings, like those numbers do not scream we're going to see a crazy amount of inflation going forward. Now, obviously, I could be wrong about that, but that's just my best guess. Like that's and the fact that the Fed is I mean, the last meeting like a week and a half ago or whatever, they're clearly shifting to dovish. That kind of says that, hey, our main concern, at least over the medium to long term, is not inflation. So that's just my best guess. Obviously, I could be wrong, but that's just what I'm thinking. Especially considering the Fed is I mean, they're basically done QT. They're probably going to be doing QE within the next 6 months to a year, I would guess. And by then, I think that the tariff scares are going to be beyond us. And I mean, if you look at the recent tariff news too, like Trump talked to Mark Carney this past week, and seemingly it was a fairly positive talk. Basically have to go off what Trump is saying here, but I mean, Carney didn't seem overly concerned either. So I think that you can already see that they're rolling back the amount of tariffs that they were originally proposing. Now again, we're going to find out on, I guess it'll be Wednesday that we find out exactly what's going on. But I mean, for all we know, they impose them and they roll them back again. Who knows? But I think that the tariff scare is already priced into the markets. Right? It's already priced into the markets. A small chance of a recession is probably already priced in as well. We're going to need to see something else to drive the markets even lower yet. 5,500 on the S&P is a pretty good support level. Not that we can't go lower, because we certainly can. For all we know, we see a recession and we do go lower, and the recession's worse than we expect. But everything that we know right now is already priced in. So just keep that in mind. This from Daniel Pronk. One thing I think isn't discussed enough is how consistently buying stocks increases your average price and lowers your returns, or percentage returns. I often see people not wanting to average up because of this, and I think it's a mistake. My goal when investing is to have as much cash invested in high quality businesses as possible, and to produce the highest total dollars return, not the highest percentage gain. I can only achieve this by consistently buying and averaging up on positions, which also significantly lowers my percentage returns. For finance influencers, it creates a weird incentive to never average up so they can show the highest percentage returns possible. But I don't like this, because I think it's not an accurate reflection of how many people, myself, invest. So this is a very good point I wanted to bring up, because you do see this a lot, and not to mention too, people see I think a mistake people make too is that positions they're down on that were bad investments, they just keep averaging down, and they never actually get back to even, because even is kind of a psychological barrier on positions you're down on. Not that you should never average down, that's not what I'm saying, but what I am saying is that I think he's right in that you shouldn't be afraid to average up. But I also think that the mistake people do make is constantly averaging down on positions that were just straight up bad investments. And it doesn't mean that you can't get back to positive and try and claim some victory. You also have to keep in mind the concept of opportunity cost, in that, you might get back to even on that one investment, but are you losing out in the sense that you could have invested it somewhere else and got a better return? So that's something that I think is quite important. But you also have to keep in mind too that, this is something that I really, you don't appreciate it in the time, but I think I'll appreciate a lot in the future, is that being so young, you don't really care about anything right now. Like, when you're still really young, and for the people that are older, obviously this doesn't go for you, but when you're really young, you don't care about all that stuff right now. Like, I could care less about how much I'm up on any single position right now. Like, I really could care less. All I care about is how good do I think it's going to do in the future, right? If you're 60, even 55, 60, 65 years old, yeah, you do have to worry about that. But when you're still in your 20s, like it doesn't matter. All you care about is like the only thing, frankly, that gives me anxiety, for lack of a better way of putting it, is, am I not getting enough into these names? Like, that's the only thing that really bothers me. And the problem I'm trying to solve is, how do I get more money into these positions? Like frankly, I don't even really look at. I obviously see it, but that's one of the least important things for me is how much I'm up. Like, it really isn't. The only thing that matters is it a good company, and do I think it's going to be able to grow in the future? If the answer is yes, I really don't care about the price, because price returns will follow fundamental returns at some point. If you have a position that is growing well fundamentally, but the price isn't, it's only a matter of time. Obviously it's not a guarantee, but overwhelmingly likely. And at the end of the day too, that's one of the main things about investing, is that it's a matter of playing the odds. Like, it's really a matter of playing the odds. If something's overwhelmingly likely to work out in your favor, yes, sometimes it's not going to work out in your favor. But if you do it enough over time, that's where the returns come from. And if you look at the best hedge funds, like hedge funds, that's typically how they make money. Hedge funds typically do not buy. They're not Warren Buffett. They don't buy and hold sometimes, but the vast majority, like the way that they make money is by making. They'll make investments where there's like a 51 or a 52% chance that it works out, and they'll just do it thousands of times or tens of thousands of times per year. And when you do that 10,000 times per year, and you do it over a period of 20, 30, 40, 50 years, you make a lot of money. Like, you make a lot of money. And that's really the way to think about it, is simply like, if a company is growing its fundamentals well and it's priced fairly, its valuation is good, overwhelmingly likely you're going to do well in that investment. So just my 2 cents there. The other big news from earlier this week, Gamestop is going to start buying Bitcoin. They have $4.75 billion on their balance sheet right now. Now, apparently they're going to start issuing convertible bonds. I don't know why. I mean, I understand why, and that's the model that MicroStrategy has set out. But when you got $4.75 billion in cash, that makes no sense. I mean, I would be putting at least half of that in Bitcoin. That's just me. I don't know if I'd put 100% in, but I'd probably be putting half, maybe 2/3, maybe 3/4. That's just what I would guess. But again, this is just another domino that's starting to fall. After announcing this, they were actually up quite considerably. Then the next day, they actually turned down again. I still think that the average person does not understand this. Like, I think that 1 or 2, maybe 3, 4, 5% of the market actually understands what's going on here. And I've said this is one thing that I disagree with a lot of hardcore Bitcoiners on, is that they think 100% of people are going to adopt Bitcoin one day, and it's going to be, it's going to replace the dollar and all these other currencies. And I could see that. I certainly could see that. But you also have to keep in mind that the average person is pretty ignorant. Like, the average person is completely financially illiterate. So, stocks and real estate is already a way to make a lot of money. What makes you think that Bitcoin is going to change them on that? Like, Bitcoin, I think, is a way to make even more money, but what makes you think that they're just going to change? Like, they've already demonstrated quite clearly that they're not going to change. So my base case is 20, 30, 40, maybe 50% of the population will adopt Bitcoin, and probably the same goes for corporations. But I don't think it's going to be 100%, at least in the near future. 100 years from now, a lot can change, but then in the next 10 or 20 years, I just don't see it. Like, I really don't see it. And the last thing I wanted to touch on here is WRB. This is a stock I talk about a lot. This is one of my favorite positions. They were up very significantly on the week, about 12%, give or take. And basically, it was a big name Japanese investor basically said, hey, we're taking, I think they're going to buy quite a large position in the company. So that was good. I mean, I wish I had a larger position in this. I started buying this. I know it was right around $50 a share. I feel like it was back in July at this point. Maybe it was back in June around here. But I know it was right around $50 a share, maybe just over $50 a share. So, I mean, I'm up, what is that, 40% on that original position in less than a year, when the S&P's up, maybe 10, 12% in that time. So, obviously, I've killed it on this position. But again, coming back to the point that I just made here, I'm still buying the stock. Like, I'm still buying the stock. And the reason for that is, I think it's a very good company, and if we look at its PE here, it's still below its 5-year average. Now again, it's over 15 now, so I think it's very close to fair value. I think I remember saying in the last video that around 70 was fair value, but based on this, I would be buying it honestly right up until my cutoff point is right around that 5-year average PE mark. So we're talking just over 16 and a half, 16.6, maybe 17. So that implies that we're still about 10% undervalued, maybe 7%, I guess, according to this. So we'd probably have to go up to 75 to 80 a share, at least just based on that. But you also have to keep in mind, too, that earnings will be coming out soon, and if they announce good earnings, well, that just will increase the base on that. So I definitely am still buying here, but it definitely is bordering on. I think you could argue it's fair value where it's at right now, but I'm not. I'm going to keep buying until it goes to that 5-year average PE. That's obviously not some number that's set in stone, but that's just my base case. When it gets to that number, I will reevaluate and go from there. That's just what I'm saying. So anyway, that's what I wanted to talk about today. If you liked the video, please like, subscribe, comment. Check out those links below and stay tuned for more.